You picture a life of pure luxury. You imagine sleek, multi-million-dollar Gulfstreams or Learjets parked on private tarmacs, accelerating down the runway and lifting off to whisk wealthy executives away to exotic destinations. You do the math in your head. If you charge $10,000 to $25,000 an hour for a private charter and simply keep your planes in the air, you are looking at effortless, high-flying profits. It looks like the ultimate premium asset play. But the retail side of aviation hides a brutal reality. Chartering jets is an asset-heavy logistics struggle, where your multi-million-dollar inventory loses value every single day it sits on the ground. Today, we are stripping away the glamorous travel agency facade. We are putting the actual math under the microscope to see the unforgiving economic engines that keep this industry airborne. The luxury price tag on a private flight is a mask. Beneath that facade, charter operators are locked in a struggle against a cost structure that can turn a full flight into a net loss the moment a single component requires service. Simply getting permission to operate is a massive regulatory hurdle. You have to survive the FAA Part 135 audit, a grueling months-long process of safety checks and proving you have a dedicated maintenance director and chief pilot on staff. Then there is the cost of the metal. A pre-owned light jet easily demands $3 to $5 million, while a large cabin long-range aircraft like this Gulfstream will push past $30 million before you ever book your first passenger. This high barrier to entry makes the hourly rate a deceptive number. A $25,000 flight fee barely covers the immediate operational costs, specialized jet fuel, expensive landing fees, and the mandatory engine reserve funds required for every hour the turbines spin. This chart illustrates the gas station problem. For a charter company, flight hours are a high-cost, low-margin product designed only to keep the machine running. Once you pay for the fuel, the maintenance, and the insurance, the actual profit is nearly non-existent. Because the core product operates at such thin margins while demanding massive infrastructure, operators are forced to build entirely hidden financial engines to extract a profit. The smartest operators avoid the financial risk of owning the aircraft altogether. They have found a way to run a fleet without the crushing weight of asset depreciation. They use a managed fleet model. This operates like a car dealership, which generates its real gross profit in the service bays, on labor and parts, rather than on the front-end sale of the car. The charter company manages the jet for a wealthy owner, handling the pilot staffing, the maintenance, and the hangar space. They collect heavy monthly fees for this management, essentially turning their infrastructure into a recurring revenue stream. When the owner isn't using the plane, the company rents it out to the public. They take a 20% commission on every chartered hour, getting all the upside of the flight revenue with none of the ownership risk. This structure shifts the physical depreciation onto the wealthy individual, while guaranteeing the charter company a risk-free slice of every hour the plane is in the air. But commissions alone don't provide the liquidity needed for daily operations. For that, the industry relies on a high-end subscription play called the Jet Card. Flyers pay $100,000 or even $250,000 completely up front to buy a block of 25 or 50 flight hours. This creates a negative cash conversion cycle. This diagram shows how the company collects a massive pile of cash on day zero, while actual expenses, like fuel and pilot shifts, aren't paid out for 60 or 90 days. This gives the charter company millions in interest-free financing, funded entirely by their clients. They can use this cash flow to fund operations months before the service is actually delivered. The Jet Card model proves that hoarding liquidity is the true lifeblood of the business. This upfront cash prevents the company from suffocating under its own massive fixed costs. Even with managed fleets and prepaid cash, charter companies face existential threats. They are high-leverage businesses built on top of staggering fixed costs. This is the volatility trap. Much like an airport that must keep the lights on and security lanes staffed regardless of passenger volume, a charter company's hangar leases, simulator training, and crew salaries remain flat, even if demand drops 40% during a recession. Then there is the deadhead trap. If a client pays for a one-way flight from Chicago to Aspen, the company must fly that plane back to base. If they can't find a client for that return leg, the aircraft flies empty. Burning fuel and crew hours on just a few of these empty return flights can instantly vaporize a company's quarterly profit margin. One bad week of empty legs can turn a profitable year into a total loss. Owning a private jet charter company is a high-stakes, highly leveraged exercise in hospitality and logistics. It requires winning a relentless daily war against empty legs, strict maintenance schedules, and physical aircraft depreciation. The ultimate luxury product survives because operators have mastered the art of the shift. They have convinced the ultra-rich to shoulder the catastrophic asset risks while simultaneously paying upfront to fund the company's cash.